Hey everyone, this is Mike Jesowshek, Managing Partner over at JETRO and Associates. I want to shoot this quick video as we have had many business owners coming to us inquiring about S corporations. My goal is to give a quick overview and understanding of the benefits of S corporations so that you, the business owner, have a better idea and can make a more informed decision if this is something you are interested in. If you operate your business as a sole proprietor or a single member LLC, which is taxed as a sole proprietorship, you may pay as much in self-employment tax as you do in income tax. If that's the case, you definitely want to consider setting up an S corporation to reduce that tax. We typically say it makes sense for anyone with business income from $20,000 to $30,000 and up. But contact us beforehand and we can give you a custom idea on if it makes sense in your specific business. If you are taxed as a sole proprietor, you will report your net income on a Schedule C. This is right on your personal return. You'll pay tax at whatever your personal rate is, but you'll also pay self-employment tax of 15.3% on your first $118,500 of net income, and then 2.9% on the net income that is in excess of that $118,500. So, let's say your profit at the end of the year is $100,000. You'll pay regular tax at your regular rate, whatever that is. You'll also pay about $15,000 in self-employment tax. The self-employment tax replaces Social Security and Medicare tax that your employer would pay and withhold if you were not self-employed. So now that we know that, let's learn a little bit more about what an S corporation is. An S corporation reports their income and expenses separately from your personal return. So you will file an S corp return for your business, which will provide a K-1 to you personally that you will then use to report that on your personal return. Notice this is much different than a sole proprietor or single member LLC because your business is included directly on your personal return with them and not separately. In a nutshell, in order to create an S corporation for your business, you must have less than 100 shareholders, be located in the U.S., and it cannot be owned by another corporation, partnership, or non-resident alien. It is also important to note that you must take a reasonable salary as an S corp owner, and we will look into this further on. As I just mentioned, the S corporation must pay you, the owner, a reasonable wage for the work you do. Any profit that is then left over passes through to you on your personal return as income. Essentially, as an S corp, you split the owner's income into two separate parts, salary or wages, and pass-through distributions. This is why the S corporation is much more attractive for sole proprietors or single member LLCs. You essentially will still pay the same 15.3% self-employment tax on the salary or wages you take from the company. However, the remaining amount you take as pass-through distributions, you will not have to pay self-employment tax on. Let's take a look at a real number example to help this make a little bit more sense. Let's assume your business has net income of $100,000. If you are set up as a sole proprietor or single member LLC, you will have to pay your regular tax rate plus 15.3% self-employment tax on that full net income amount of $100,000. Now let's use the same information but put it in an S corp. Let's imagine that you take a reasonable salary of $40,000. In this scenario, you would pay 15.3% self-employment tax on that salary amount of $40,000. However, on the remaining $60,000 of net income, you would not have to pay self-employment tax on. In this scenario, you would save over $9,000 in taxes simply by being taxed as an S corporation. Also understand that this amount you save is not just this year, but every single year you are in business. There's no guide as to what a reasonable salary is, and this is something that is often argued with fellow accountants. For our clients, we do work with a software provider that can evaluate your duties and tasks and figure out a reasonable salary for you, and they also provide a report for backup in the event of an IRS audit. However, if you don't want to go into that much detail, we typically tell our clients, in general, you need to pay between 20 and 40% of your net income in salary to yourself. And most importantly, do not be greedy. Do not run no payroll, or the IRS will catch up to it and you will have to pay back taxes on that amount. Now let's take this a little bit further and understand the audit odds of companies. As you can see by this graph, not only are you saving a bunch of money in taxes, but your likelihood of getting audited is also reduced. The audit rate of a Schedule C, which is a sole proprietor or single member LLC, can range from 1.2 up to 3.6%. However, the audit rate of an S Corp is much lower at just 0.5%. This is just another added benefit of S Corps. Setting up an S corporation is going to be more work than a sole proprietorship. However, as you can see, the benefits far outweigh this extra work. First thing you need to do is make sure you are eligible. As mentioned earlier, this means having less than 100 employees, you must be a US-based corporation, and shareholders cannot be another corporation, partnership, or non-resident alien. Next, you have to incorporate or form an LLC if you do not already have one, and this includes filing articles with your specific state and obtaining an EIN from the IRS. Once this is completed, you must file Form 2553 with the IRS, indicating that you are electing to be taxed as an S Corp. This must be submitted within 2 months and 15 days after the tax year of the election. There are late elections available if needed, so contact us if we're already past that 2 months or 2.5 month period. But once accepted, the IRS will send you a letter of acceptance, and then you're good to go for your tax return. When running payroll, it does involve a couple more steps and requirements, as well as some other year-end formalities that you will have to do as a corporation. On a quarterly basis, you will have to file tax reports with the federal and state government agencies. These include Form 941, state withholding, state unemployment, etc. And on an annual basis, you will have to create a W-2 for yourself and send in a W-3 to the IRS, along with Form 940 for federal unemployment. As mentioned above, you will also have to submit a separate tax return for your business, which is a Form 1120-S, and then whatever kind of state requirements you have for tax returns. However, with all that being said, we have packages here at JETRO that allow you to get these services at an incredible price, so you are able to experience the tax benefits as corporations provide, while we deal with all the extra tasks. That lets you focus on running your business, and we'll make sure that you're compliant as an S Corp. Again, my name is Mike Jesowshek, and I'm the managing partner over here at JETRO and Associates. I want to thank you for taking the time to check out this quick video. Once you have evaluated and seen if it's something that you are interested in, please contact me and we can discuss the next steps moving forward and see if it's a right fit for you and your business. Thank you.